Welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, we're going to be talking about the 4% rule and specifically how investment fees affect our application of the 4% rule in retirement. If you watched the last video, you know I talked about investment fees during the time when we're saving for retirement, and recall that even a quote-unquote small 1% fee or even a 0.5% fee over a lifetime of investing can easily cost us hundreds of thousands of dollars and, believe it or not, even $1 million or more. If you didn't watch that video, I highly encourage it. This video is part of our 4% rule series, so if you haven't watched that, I highly encourage you to go back. There's only about 4 or 5 videos in the series at this point and watch them. But as you know, the 4% rule helps us estimate how much we can spend in retirement. We take 4% of our portfolio in year one, and then after that we just adjust it for inflation. But that raises the question of investment fees. In this video, we're going to discuss 5 key things you need to understand when it comes to the 4% rule and investment fees. Let's get right to it. The first one, arguably the most important, is this. Bill Bengen, he's the father of the 4% rule. Recall he published his paper in 1994. We're going to look at it in just a minute. He didn't assume any investment fees. In fact, he assumed, I guess you could say, 0 investment fees. He didn't actually discuss it in his paper. In terms of returns, he used effectively an S&P 500 index for stocks, an intermediate term treasury, that's U.S. government bond fund for bonds, and that was it. He didn't factor in investment fees at all. That's the first thing we need to understand. He assumed 0 in investment fees. Now, that's the bad news. The good news, and this is point number 2, if you are a do-it-yourself investor investing in low-cost index funds and relying on the 4% rule, you're in pretty good shape. Now, do-it-yourself investor, that means you're not paying an advisor, say 1% of your assets every year to manage your investments, and you're in very low-cost index funds, the kind that Vanguard offers or Fidelity or Schwab or other mutual fund companies. We're talking, 5 basis points, maybe 10 basis points. It's a very low cost. It's not free, although there are some by Fidelity that are actually free now in terms of expense ratios. But these are very, very low cost mutual funds. And I think if you're in those, you're probably in pretty good shape. Yes, you're paying some small amount in fees, but it's so insignificant that at least I wouldn't worry about it in terms of an application of the 4% rule. Now, that's number 2. What about everyone else? So that gets us to point 3. Some of you may be saying, well, Rob, I do pay an advisor, or I'm in more expensive mutual funds, or maybe both. I'm just going to ignore it and take my chances. So if I do that, what am I up against? To answer that question, I actually want to go back to Bill Bengen's 1994 paper, because he has, even though he doesn't discuss fees, the answer to this question is actually in his paper. So let's take a quick look. You are looking at his paper now. Again, this was published in 1994. Now, what you're looking at in this figure 1B is a graph of the 4% rule. So he's assuming you take out 4% in year one, adjust the amount by inflation thereafter, and he's assuming you've invested 50% in stocks. Again, he used an S&P 500 index, and the rest in intermediate term treasuries, U.S. government bonds. And you can see that he looked at retirements over a 51-year period. So this is folks retiring in 1926, all the way through folks retiring in 1976. And his question was, will their money last at least 30 years, sort of a traditional retirement time period? And with these assumptions, he said, yes, it will. In fact, the worst year, you can see it right over here, is 1966. That was the real stinker of a year. But still, even if you retired in that year, your money would last, it turned out to be about 32 or 33 years. And by the way, additional research and analysis since Bengen's 1994 paper has confirmed this information. It hasn't changed. And by the way, it still shows 1966 as the absolute worst year to retire. However, now let's factor in fees. And of course, to do that, we need to know how much you're paying in fees. If you don't know that, that's the step one. You need to find out if you're paying an advisor, how much you're paying. 1% is standard, but there are certainly those that charge a lot less and those that charge a lot more. But you also need to know the weighted average of your expense ratios of the mutual funds you're in. I use the tool Personal Capital. If you link all your retirement investment accounts, it will generate this information for you automatically. But of course, you can do this on your own by hand. If you have an advisor, your advisor certainly should know this information. So now let's assume that when you add up all your fees, whether they're advisor fees, mutual fund fees, or both, your fee is 1%. How does Bengen's paper help us understand what would happen in that case? Well, the answer is you would basically have a 5% initial withdrawal rate, right? 4% that you're going to spend, to live, and 1% that's going to fees. So what would that look like? Well, he actually had that in his paper. We can scroll down here. This first box, this is figure 1C, has an initial withdrawal rate of 5%. Now, I should say before we go forward that this is not a perfect analogy because as the markets change, go up and down, the 1% that you're going to be paying will go up or down. Unlike your withdrawals, which are adjusted for inflation each year, your mutual fund expenses and your advisor expenses, they're not calculated the same way. They don't start at 1%, let's say, and then just get adjusted for inflation each year. It's always, again, in our hypothetical, 1% of the amount invested. But I still think this table, which we're going to go back to, with an initial 5% withdrawal rate, is a good approximation of what your future might look like paying this 1% fee. So with that, let's go back to his paper. And you can see that for many retirement years, your money barely lasted 20 years. That's true here in 1937. It's definitely true in the 60s, including 1966, which still continues to be the worst year to retire in, but also 68, 69. So there are a number of years where your money would not last 30 years, would barely last 20 years. Now, what about those that might be paying 2% in fees? Maybe a 1% advisory fee, and then your advisor has you in expensive mutual funds that cost on average 1%. Well, we can go down to figure 1D. This had a 6% initial withdrawal rate, and you can see, boy, some of these years just got decimated. Well under 20 years, their portfolios were exhausted after about 15 years. So taking out an initial 6% from your portfolio and then adjusting for inflation, depending on when you retire, could be devastating. Of course, there are some years, as you can see here, where things worked out just fine. The problem is you're not going to know when you retire whether you're retiring in a good year or a bad year. You're not going to know that, well, frankly, until it's too late. So again, I want to stress this isn't a perfect analysis because, again, your fees don't get adjusted for inflation as you move through retirement like your spending does under the 4% rule. They're going to go up and down based on how the market does because they're usually based on how much you have invested. But still, I think these charts, these tables, give us a rough idea of the impact fees can have on your portfolio. Now, a fourth point is you could say, well, I'm not comfortable ignoring the fees. So what I'm going to do is start at 4%, but I'm going to deduct the fees I pay out of that 4%. So if I'm paying, an advisor 1% and he or she's got me in mutual funds that cost 1%, that's 2% that comes out of my portfolio every year. And whatever that amount is, I'm going to deduct it from my 4% calculation and reduce my spending accordingly. Well, that's certainly a reasonable approach from retirement security, but as you can imagine, it's going to wipe away a lot of your spending power right off the top. And in fact, I think many people wouldn't be able to survive in retirement on the 4% rule if they first had to reduce their spending by the actual dollar amount of all of the fees they were paying. And that's point 4. If you're not going to ignore the fees, they really start to hurt your retirement spending. Now, what some might say is, well, my advisor is so good, and the mutual funds we've picked, they're expensive, but they're so good that I'll be able to beat the S&P 500 index. We'll do better, even on an after-fee basis, of all of these low-cost index funds. Well, if you watch the last video, you know the problem with that is that study after study after study shows that that just ain't reality. Sorry, over a long period of time, think a decade or more, the index funds beat out the actively managed funds. It's true whether it's a large cap fund, a mid cap fund, or a small cap fund. So yes, you can reduce your spending based on the fees, and that's probably the safe thing to do if you're paying these fees. But as you can see, it's going to really reduce the amount of money you can spend in retirement. So having said all of that, point 5, I want to end on a high note, because some of you at this point are saying, Rob, I get it, you've convinced me, fees matter, but listen, I need some help. Well, there are options that you can consider where you can get help that don't cost an arm and a leg. And I want to give you some very specific options. So the first is Vanguard Advisory Services. In fact, let me show that to you on the screen. Here's the website, and I'll leave a link to this in the show notes below the video. But this is an advisory service. You can see it costs 30 basis points. So it's not zero, right? This is still going to affect what you can spend in retirement, but it's obviously a lot less than what most advisors charge. Sort of the standard fee in the industry is 1% of assets under management, AUM. Vanguard charges just 30 basis points. So this is one option. A second option is to work with an advisor who charges you a flat fee. Now here we have to be careful. You've probably heard the term fee-only advisor, and they have a fiduciary duty to you, and they'll argue that they're much better than those brokers who are really just salespersons earning a fee off of you when they direct your investments in a certain way. But here's what a lot of people don't understand. Fee-only advisors are expensive. Like I said, the standard fee is 1% of assets under management. Can you imagine anything else you would buy where you would pay 1% of your wealth each and every year? That's just insanity. So I'm not talking about fee-only advisors that want to charge you, say, 1% of assets under management. I'm talking about advisors who will charge you a flat fee. Think a couple $100 a year, maybe $1,000 a year. That's going to be far less expensive than paying an advisor based on assets under management. Let me give you an example of one, and it is Mark Zorel. He owns Plan Vision. Now, I've known Mark for many years. I should say, first off, I have no financial connection with Mark at all. He doesn't know that I'm including him in this video. I don't make any money from him. I never have. In fact, I'm a client. We talk about once a year, but here's his deal. He is not going to actually manage your investments, make trades for you. But what he is going to do is get an understanding of your entire financial picture, and then recommend a portfolio for you and a spending strategy for you and the best way to take money out of all of your different retirement accounts. But it's going to be up to you to actually make the trades, make the investments. He can walk you through rebalancing, but you're the one that's going to actually have to rebalance. But he's going to be there for you to help you understand what's, in his view, your best approach. And you obviously be able to talk with him, ask questions. And I find Mark to be very approachable, and I think he's a great option. Now, he's not the only, I call them flat fee advisors to distinguish them from fee-only advisors. He's not the only one. He's probably the one I know the best. I've worked with him. I like him. You may find others, and they're certainly out there. In fact, if you know of any really good flat fee advisors, leave a link or a comment below telling us about them. I'd love to kind of create a big list of flat fee advisors that folks could at least consider. So that's the second option. You've got Vanguard Advisory Services, then you've got flat fee advisors who aren't going to charge you assets under management, which drain your wealth when you need it the most, retirement, right? Now, there is a third option, and that is sort of the robo-advisors or digital advisory services. These are companies that use technology to help with everything from portfolio construction to rebalancing to spending. I'll give you two examples. These are by no means the only two, but I'll give you two examples. So let's check it out on the screen again. The first, going back to Vanguard, right? You know, I love Vanguard. Vanguard Digital Advisors. So this is, I think, 15 basis points. And again, it uses technology. It'll help you determine what your portfolio should be and all of those sorts of things. And so this is one option. One that I really like, though, beyond that is actually Betterment. I met John Stein. He's the founder of Betterment. Goodness, it's been a decade ago, I think. And I've had accounts at Betterment in the past to test it out. I don't today. But they have, of course, a lot of investment tools. They will help you figure out what portfolio is best for you. Once you have it set, they actually take your money, put it in low-cost ETFs. They do all the rebalancing for you. It's very hands-off. But here's the thing, and again, I'll leave links to this below. They have tools specifically designed for those in retirement that help you take all of your money and generate retirement income. So again, this isn't the only option. Neither is Vanguard Digital Advisors. There are plenty of robo-advisors out there, and there may be even others that are best for your specific circumstances. But I really like these options. So if you're looking for help, there are options, right? You don't have to do it on your own. But the big takeaway is if you're going to rely on the 4% rule, just keep in mind, Bengen did not factor in fees. When you start to add in fees, particularly sort of the typical advisory fees that you see and expensive mutual funds, it will either impact how much you can spend in retirement, or if you choose to ignore it, it will increase the likelihood that you'll run out of money in retirement. Listen, if you have any questions, leave them in the comments below. I'll help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.